All right, diving in. Welcome to the deep dive. You know how it is, right? Information overload everywhere you look.
It's true.
And so what we try to do here on the deep dive is sift through all of that and try to pull out the really key insights you need so you can get well-informed quickly about a topic. Today we're tackling something I know a lot of people are thinking about, and that is successful stock market investing.
Yeah.
So our guide for this deep dive is Trade Like an O'Neill Disciple, How He Made 18,000% in the Stock Market
Wow.
by Gil Morales and Kacher.
Right.
And these guys know what they're talking about. I mean, they were former portfolio managers at William O'Neill Plus Company. So,
Exactly. And, you shared this material with us, our listener, because you're looking for a shortcut.
right.
You want to cut through all that noise and figure out, what are the fundamental principles that really drive success in the market. You want actionable strategies, not just some abstract theories.
Right. Like, what's the difference between the people who can actually pull this off and achieve these huge returns versus everyone else who seems to struggle to make any money in the market?
Exactly.
So that's what we're going to be exploring today. That central question, really drawing on this book, Morales and Kacher's interpretation of William O'Neill's work. What are these core practical strategies that separate the consistently profitable investors from everyone else?
Yeah.
And as we'll see, it's often counterintuitive.
It is.
Right.
Yeah.
So we're going to be drawing on excerpts from the book directly. Morales and Kacher took all of their years of experience, all their observations of the market, and distilled it down to this set of rules that they say are based on common sense. But we'll see if they are. I'll let you, the listener, be the judge of that.
We'll see.
And so our listener, you're looking for that distilled wisdom, right? You want to get to the essence of this approach without getting bogged down in all of the unnecessary complexities. So let's dive in.
To some of the most crucial elements they highlight.
Well, the first thing they talk about is the absolute necessity of preparation of doing your homework. O'Neill famously said, and I love this quote.
90% of the people in the stock market simply haven't done enough homework.
Yeah.
I think about how many people just kind of jump into the market and they haven't really taken the time to understand what they're doing.
That's so true, though, isn't it? I mean, I think we see this in so many areas of life.
We do.
But especially investing. There's this allure of quick riches, right? I don't know about you, but my inbox is constantly filled with all these, hot stock tips and get it on the ground floor of this thing and it's going to go to the moon. And of course, they never mention all the ones that crashed and burned.
Yeah.
Right? It's always, the survivors.
Hindsight bias.
It is. It is. And so, but what Morales and Kacher are saying, and this is very consistent with O'Neill's philosophy, is that success in the market takes work.
Right.
I mean, it's like any other profession where expertise is valued.
Yeah.
You wouldn't want a surgeon operating on you who didn't go to medical school.
Right. Yeah.
So why approach the stock market with your hard-earned money any differently?
Exactly. And it really raises an important question about what is the right mindset for approaching the market.
Yeah.
It's not just about finding some kind of secret formula, but it's about really understanding the dynamics of the market and the characteristics of these successful companies.
Yeah. And in this concept of homework, the research comes up again and again.
Yeah, it does.
Right.
Yeah.
So that sets the stage. Now let's say we've done our homework. We're ready to actually buy stocks. What kind should we be looking for? And this is where I think things get really interesting because they say you need to buy expensive stocks that are at new highs.
The red dress.
The red dress, exactly. The red dress that sells like hotcakes.
Yes.
And they use that analogy quite a bit in the book. But again, it seems counterintuitive.
It does.
Most people think they want to buy things on sale.
Right.
They want to buy low.
Right.
So unpack that for us. What's the reasoning behind this?
Well, as consumers, we're used to looking for discounts. We want to buy things when they're cheap, right? But Morales and Kacher are saying the stocks that really generate the big returns, those market leaders are the ones that are actually breaking out to new price highs.
Yeah.
And you think about it, a stock hitting a new high, it means there's a lot of demand. There's positive sentiment. And so going back to their analogy, the popular item is not the one that's gathering dust on the sale rack.
Right.
It's the one that's flying off the shelves.
Right.
Right. And the reason for that is that, a stock breaking out to new highs, it often indicates a change in the underlying fundamentals of the company.
Yeah.
It could be a new product. It could be a new service. Yeah. Something's driving that demand.
Right.
And the institutional investors, they're recognizing that and they're acting on it.
And so we really have to fight that urge to bargain hunt.
Right.
to wait for that stock to go down and down and down, and then think, oh, okay, now's my time to buy.
You're trying to time the bottom.
You're trying to time the bottom. And as they say, that could be really dangerous.
It is.
And they explicitly contrast buying these, leading stocks, these red dress stocks, with what they call the yellow dress stocks,
Right.
which have been marked down. And they bring in some wisdom here from Jesse Livermore.
Oh, yeah.
This is a guy who's a legendary investor and someone who really influenced O'Neill.
Right.
And Livermore cautioned against buying stocks just because they've fallen a lot.
Right.
There's a reason they've fallen.
Right.
They might still be overvalued even at that lower price.
Exactly. Don't try to catch a falling knife.
Yeah, you're probably going to get hurt. And so, if we think about this more broadly, what they're talking about is following the momentum.
Yes.
Right. The market is essentially telling you which companies are experiencing that increase in demand, those positive developments.
Exactly.
And if you're trying to find the cheapest stock, you're often investing in companies that are facing headwinds.
Yeah.
So, okay, we're buying these expensive stocks. We're looking for the strength. But of course, not every investment is going to be a winner. And this is where we get to, I think, one of those important principles.
Yes.
Which is cutting your losses quickly.
Absolutely.
And Morales and Kacher, they have a very strict 6 to 7% automatic stop loss policy.
Yeah.
Like once the stock goes down 6 to 7% from where you bought it, you're out.
Yeah.
Why is that level of discipline so important?
Well, that is a cornerstone of their risk management strategy.
Yeah.
And that 6 to 7% stop loss, it's not just an arbitrary number.
Yeah.
It's really designed to protect your capital. And I think importantly also your mental state as an investor.
Yeah.
Right? So first of all, it limits the potential downside of any trade you make. By cutting those losses early, you prevent, a small mistake from turning into a major financial setback.
Right.
Livermore said it really well. He said, losses are twice as expensive to make up.
Yeah.
So you don't want to let those losses get out of control. And the second thing, and I think this is maybe less obvious, is it helps to preserve your confidence as an investor.
That's such a good point.
Because taking a small controlled loss is much easier to recover from psychologically than if you let that loss run and it turns into a huge drawdown.
Yeah.
And it can shake your faith in the whole process,
Yeah.
what you're trying to do.
Yeah.
And so it's not just about avoiding the big losses, it's actually freeing up that capital
Right.
to put into better opportunities.
Right.
So you're kind of pruning the garden,
Right.
getting rid of that weak growth.
Yeah.
So the strong growth can flourish.
Yeah.
And you're not emotionally tied to that position anymore. You've moved on.
Yeah, exactly. It's
Yeah.
about minimizing the damage from your mistakes so you can live to fight another day.
Yes.
And again, they bring in Livermore here, emphasizing that small loss.
Yeah.
And also Richard Wyckoff,
Yes.
another influential figure in market analysis.
Yeah.
And he saw stop orders as the first line of defense,
Yeah.
right? So this isn't just a suggestion. It's like a fundamental rule for long-term survival and success in the market.
Yeah. If you think about it as part of your overall risk management plan,
Yeah.
it's having that exit strategy before you even enter the trade.
Yeah.
Takes the emotion out of it.
Yeah, and forces you to adhere to this disciplined approach.
Yeah.
Okay, so we've talked about when to exit when things go wrong.
Yeah.
But what about when we're right?
Yeah.
What about when we have a winner? And this is where they talk about letting winners run and taking profits slowly,
Yes.
which again can be a little counterintuitive.
Yeah.
A lot of people, they're so quick to just like, oh, I've got a little gain.
Want to take my profits.
Let me lock this in.
Yeah.
I'm out of here. But
Well, and I think this is a natural extension of the trend following approach that O'Neill advocated,
Yeah.
is that once you've identified a stock that's in a strong uptrend, you want to resist that urge to sell too early,
right.
to lock in those small profits. Livermore, famously, he said, as long as the stock is acting right and the market is right, do not be in a hurry to take a profit.
It's so hard to do though, isn't it?
Yeah.
I think emotionally,
It is.
it's so tempting
It-
to want to just be like, okay, I made a little bit. Let me take it off the table.
Yeah.
But what you're saying is that by doing that,
Yeah.
you're really limiting the potential upside
Exactly.
of the trade.
Yes.
And they talk about, they contrast this really with what they call being in the zone, right?
Yeah.
You've identified this powerful trend and you're just letting it play out and you're just riding that wave.
Yeah.
And Livermore had this great quote. He said, it never is your thinking that makes the big money for you. It's the sitting.
Yeah.
And Livermore actually echoed a very similar sentiment. He said, limit your risk and let your profits run.
Yeah.
It's simple, but it's so powerful.
Mm.
And again, I think it connects back to what we were saying earlier about buying strength.
Exactly.
Right? You've identified a looting stock.
Yeah.
It has strong fundamentals.
Yes.
It has institutional support. Why would you limit its potential?
Yeah.
By taking a small profit early on.
You really want to maximize the gains from your winning trades. And that's going to more than compensate for the small controlled losses.
Yeah, exactly. And that leads us to another important principle that they highlight, which is this concept of position concentration. And again, this is another area where O'Neill's approach deviates from conventional wisdom, which is, diversify.
You put all your eggs in one basket.
Exactly. And what they're saying is, no, actually, you want to concentrate your capital in a smaller number of stocks that are really showing strong trends rather than spreading it out thinly across a lot of different holdings. So why this more focused approach?
Well, they argue that excessive diversification, which you often hear referred to as closet indexing, where you basically have a lot of small positions that mirror a market index, it significantly dilutes your returns.
Yeah.
Right? If you own 100 different stocks, even if some of them perform really well, their impact on your overall portfolio is limited. Right. So Morales and Kacher, following O'Neill, they believe that superior results are achieved by focusing on a few stocks that you've really researched that have that strong upward momentum.
And there's a great quote in here that I really liked.
Oh, yeah. What is it?
Where they quote, Gerald Loeb and O'Neill actually agreed with this.
Okay.
That diversification is a hedge for ignorance.
It is.
So they're really not pulling any punches here.
Yeah.
And O'Neill himself, he says, the best results are achieved through concentration. Watching those baskets very carefully.
Yeah.
Right. And Livermore. He also cautioned against spreading your attention too thin.
Yeah.
Right? It's so much easier to monitor a handful of stocks than, a huge, unwieldy portfolio.
Of course.
And I love the analogy that O'Neill uses. He says you don't need to kiss all the babies.
I love that one. Right.
You don't need to own a little bit of everything
to
achieve significant returns.
Yeah.
Focus should be on finding those one or two big winners.
Yeah, and that's why they emphasize the research, because you just simply can't do in-depth research on dozens and dozens of companies.
Right.
So if you focus your investments, you can dedicate your time and effort to really understanding the fundamentals of those few stocks with the greatest potential.
Okay, so this emphasis on finding the best stocks naturally leads us into, this idea of institutional sponsorship.
Yeah.
And what they refer to as the big stock principle.
Right.
So can you explain why identifying stocks that are being actively accumulated by those large institutional investors?
Yeah.
Why is that so critical?
Well, they're basically saying that if you want to see a significant price appreciation in a stock, you need substantial buying pressure.
Yeah.
Right. And the biggest source of that demand comes from institutions, these large institutional investors.
These are the big players.
They're the big players, yeah.
Right.
Mutual funds, hedge funds, pension funds, insurance companies. And O'Neill actually draws an interesting parallel between these modern institutions and the pools and the trusts that Livermore and Wyckoff talked about, back in their day.
Yeah.
Right. Because those were entities that were able to influence stock prices through their large trading activity.
Yeah.
And now these big institutions, they can have a huge impact on stock prices.
Right.
And it's a signal of conviction when they start moving into a stock.
So it's about following the smart money.
It is. It is.
Right. And they say, look for stocks that are held by at least one or two of these savvy portfolio managers.
Right.
Ones who have a track record of success. And Wyckoff, he also talked about understanding who's really in control of the supply and demand for a stock.
Right.
Is it the institutions or is it just, John Q. Public?
The public.
Right. And O'Neill has something that he calls the big stock principle, which I thought was interesting. And he says that this involves understanding where these institutions have to be positioned within different phases of the economic cycle.
Right.
And so by identifying these stocks, you're essentially aligning yourself with that informed buying pressure.
Exactly.
Yeah.
And that's where you can see those really big moves.
Okay. So we have a better sense of what types of stocks to look for.
Yeah.
Those with strong fundamentals, backing of these institutions.
Yeah.
But how do we pinpoint those entry points?
Right.
And this is where the analysis of chart patterns comes in.
Yes.
Or what O'Neill calls bases. And he identifies a specific set of patterns, such as the cup with handle,
right,
the flat base. What are these patterns and why are they significant?
Well, I think it's fascinating how O'Neill really built on the work of Nicholas Darvis, who you might remember as the guy who wrote How I Made $2 Million in the Stock Market.
Oh, yeah?
And he observed that stocks tend to move in these boxes.
Yeah.
Right.
Defined by consistent uptrends or downtrends.
Yeah.
And O'Neill took that initial concept and he developed this much more detailed, actionable classification of what he calls bases.
Yeah.
Right? And so these bases, and there are all sorts of them. You've got ascending bases, cup with handles, double bottoms, square boxes, flat bases, high tight flags.
Yeah.
What they represent are these periods where a stock pauses in its upward movement to kind of consolidate its gains before potentially embarking on its next advance.
So it's like it takes a breather.
Yeah.
Catches its breath before the next surge upward.
Right. Exactly.
Exactly.
And so are these just random fluctuations in the price on the chart, or are they actually reflecting something deeper?
Yeah. No, they're reflecting the underlying dynamics of supply and demand.
Yeah.
For that stock.
And they talk about Darvis's boxes.
Right.
Right.
Yeah.
Where the stock would trade within a relatively consistent high and low range.
Right.
And he famously said that he didn't care how long a stock stayed in its box as long as it stayed within those boundaries.
Yeah.
Right. But what you're saying is that O'Neill's analysis is much more refined. He's taking into account the duration and the depth of these bases.
Yeah. Yeah. So he not only categorized the different types of bases,
Right.
but he established guidelines regarding how long they should ideally last and how deep they should be.
Yeah.
And he based all of this on his extensive historical analysis of past market leaders.
Right.
Because he observed that the patterns that you saw in winning stocks, they tend to repeat themselves.
Right.
Over and over again.
So it's about recognizing these patterns
Exactly.
as potential springboards for that next move upward.
Yeah. Yeah, because those bases represent periods of equilibrium between the buyers and the sellers.
Yeah.
And when you see a successful breakout from a well-formed base, accompanied by that strong volume, that can signal that that uptrend is resuming.
Yeah.
Often fueled by that renewed institutional accumulation.
So, wow, we've covered a lot today.
Yeah.
I mean, we've talked about the importance of research.
We have.
The seemingly paradoxical strategy of buying stocks at new highs.
Yeah.
The need to cut your losses quickly.
Right.
Letting your winners run.
Yeah.
This idea of concentrating your portfolio in those high conviction ideas.
Yeah.
The importance of following the institutional money.
Yeah.
And the value of understanding those constructive chart patterns.
Right.
And it seems like all of these things are really interconnected and essential elements.
They are.
Within Morales and Kacher's interpretation of O'Neill's approach.
Exactly. And remember that while some of the foundational ideas behind these principles can be traced back to, the Livermores and the Wyckoffs of the world, William O'Neill really refined them.
Yeah.
And he systematized them.
Yeah.
And he tested them.
Right.
And he created a much more concrete, actionable investment methodology.
Yeah.
And then Morales and Kacher, through their experience working in O'Neill's company, they further honed and articulated these techniques.
So as you, our listener, continue to explore these sources, really consider how these principles resonate with you. Are you starting to recognize examples of those red dress stocks?
Yeah.
Maybe some of the pitfalls of averaging down on those losing positions.
Right.
What specific insight stands out to you as something you could really apply to your own understanding of the market?
And I want to leave you with this final thought. Morales and Kacher, they achieved those incredible returns by applying these disciplines consistently.
Yeah.
So what subtle but significant shifts in your own approach to gathering information and making your investment decisions might help unlock a similar potential for you, even if it's on a different scale?
Yeah. Food for thought.
Food for thought.
Thanks for joining us.
Yeah, thanks for listening.